They told you gold was unstoppable. They told you silver was going to the moon. They told you the precious metals rally was just getting started, that the dollar was breaking down, that central banks were buying hand over fist, and that nothing could stop the train. And then, in a single session, gold crashed below $5,000. Silver dropped more than 15%. Portfolios that looked brilliant last week suddenly looked like liabilities. And the comment sections filled with the same question over and over again. What just happened? Here's the honest answer. What happened is exactly what always happens when markets get ahead of themselves and then reality shows up uninvited. But the mainstream explanation you're going to hear over the next few days will miss the point entirely. They'll tell you it's panic. They'll tell you it's manipulation. They'll tell you weak hands got shaken out. And while there's a grain of truth in all of that, none of it captures the actual mechanics of why gold and silver just got hit this hard this fast. So, in this video, I'm going to do what most commentary won't do. I'm going to walk you through the real drivers of this sell-off step by step with the actual numbers. I'm going to explain why silver got crushed harder than gold and what that divergence tells you about where we are in the cycle. I'm going to show you what the positioning data reveals about who was selling and why. And I'm going to give you a framework for thinking about what comes next, because that's the only question that actually matters. Quick favor before we dive in. I'm building something real here at Financial Crux, and that means going deeper than the surface level takes that dominate most financial content. If you find value in what we do, support the mission by subscribing and dropping a comment below. And if you want the fast updates that don't always make it into full videos, join the WhatsApp community and follow us on X. Links are in the description. Now let's get into this. I want to start by setting the scene because the numbers are genuinely striking and most people haven't fully processed what just happened. Gold futures dropped approximately 7.2%, 2% in a single session, falling to around $450. That's below the psychologically important $5,000 level for the first time in weeks. For a market that had been grinding higher with the kind of relentless momentum that makes people believe gravity doesn't apply, this was a wake-up call. But silver got absolutely demolished, down more than 15.5% to around $95 in one session. Think about what that means for anyone who was leveraged. Think about what that means for anyone who bought the breakout above $120 just a few weeks ago. Think about what that means for the narrative that silver was about to leave gold in the dust on its way to $150. That kind of divergence with silver dropping more than twice as hard as gold is not random. It's not noise. It's information. And if you understand what it's telling you, you're ahead of most investors who are still trying to figure out whether to buy the dip or run for the exits. Now, the mainstream financial media is going to give you a simple explanation. They're going to point to the fact that President Trump is about to announce his pick for Federal Reserve Chair. They're going to tell you that uncertainty about monetary policy is spooking markets. And that's true as far as it goes, but it's like saying a car crashed because the driver hit the brakes. Technically accurate, completely missing the point. The real story is about real yields, the dollar, and the positioning trap that a lot of investors walked into without realizing it. Let me break each of these down because they're all connected, and understanding the connection is what separates informed positioning from panic. Let's start with real yields because this is the variable that most people get wrong when they're thinking about gold and silver. Here's the fundamental truth about precious metals that never changes. Gold and silver don't produce cash flow. They don't pay dividends. They don't pay interest. They just sit there. And that's fine when the alternative is holding cash that's being debased or bonds that pay less than inflation. But when you can suddenly earn a real return, meaning a return after inflation on risk-free government bonds, the calculus changes dramatically. Right now, the 10-year Treasury yield is around 4.26%. That's the nominal yield, the number you see quoted in headlines. But what matters more for precious metals is the real yield, which is the nominal yield minus expected inflation. And that real yield is currently sitting around 1.90%. Let me put that in perspective. A 1.90% real yield means you can park your money in 10-year government bonds and earn almost 2% per year in inflation-adjusted terms. No volatility, no margin calls, no sleepless nights wondering if your position is going to gap down 15% overnight. Just a steady, positive, real return. When that alternative exists, gold and silver have to work harder to justify their place in portfolios. And when that alternative suddenly becomes more attractive, as happens when real yields spike higher, money flows out of non-yielding assets and into the stuff that pays you to hold it. This is not theory. This is the mechanism that has driven every major correction in precious metals over the past several decades. Real yields go up, gold goes down. Real yields go down, gold goes up. There are exceptions and complications, but that's the primary engine. And here's the part that makes the current situation particularly challenging. Inflation expectations are not rising fast enough to offset the move in nominal yields. The 10-year break-even inflation rate, which is the market's best guess at average inflation over the next decade, is sitting around 2.34%. That's remarkably stable. It's not screaming that inflation is about to explode. It's not giving gold the inflation acceleration premium that bulls were counting on. What that means is that the pressure on metals is coming from the real rate side of the equation. Investors are not fleeing because they think inflation is dead. They're repricing because they can suddenly earn a meaningful real return elsewhere. And that repricing happens fast when it happens. Now, let me add the second piece of the puzzle, which is the dollar. Gold and silver are priced in US dollars. That seems obvious, but the implications are profound. When the dollar is strong relative to other currencies, it mechanically reduces the purchasing power of non-US buyers. A Japanese investor, a European investor, an emerging market investor, all of them face a higher effective price when the dollar is firm. Right now, the trade-weighted broad dollar index is elevated near 119.29. The dollar index you see quoted on trading screens is around 96.39. Neither of these represents a dramatic spike, but neither represents the kind of dollar weakness that would provide a tailwind for metals. Here's how to think about it. When gold was running toward $5,600 and silver was pushing toward $120, those moves needed fuel. They needed buyers. And a significant portion of marginal demand for precious metals comes from outside the United States. When the dollar is firm, that marginal demand gets squeezed. The buyers who are willing to pay $5,400 might hesitate at $5,600 if their local currency has weakened 3% against the dollar in the meantime. So you have real yields that are elevated and competing with bullion. You have inflation expectations that are anchored rather than accelerating, and you have a dollar that's not providing relief for international buyers. Stack those three factors together, and you have the conditions for exactly the kind of correction we just witnessed. But there's another layer to this that most commentary completely ignores, and it's the layer that explains the speed and violence of the move. I'm talking about positioning. Let me show you what the data actually reveals. According to the most recent commitment of traders' data from COMEX, gold open interest stands at approximately 528.04 contracts. Non-commercial traders, which is the category that includes hedge funds and speculative money, are net long about 21.44,670 contracts. That's an enormous position. It reflects the accumulated bullish bets that built up during the rally. Silver tells a similar story. Open interest around 152,020 contracts. Non-commercial net longs around 25,214 contracts. Smaller in absolute terms, but significant relative to the size of the silver market. Here's the problem with crowded positioning. When everyone is on the same side of the trade, there's no one left to buy. And when the catalyst flips, when the momentum breaks, when traders start heading for the exit, they're all trying to squeeze through the same door at the same time. This creates what market microstructure people call air pockets. Prices don't just drift lower, they gap, they crash. They move faster than the fundamentals alone would justify because the selling is mechanical rather than fundamental. Traders are not selling because they've changed their view on gold's long-term prospects. They're selling because their risk limits are getting hit. Their margin calls are coming in. Their systematic models are flashing red. And this is where silver's extra volatility becomes a curse rather than a blessing. Silver has always been more volatile than gold. Its market is smaller. Its positioning relative to market depth is more extreme. And when the deleveraging starts, silver doesn't just follow gold down. It leads the way. It gaps harder. It triggers more stop losses. It creates more forced selling. That's why you saw silver drop 15.5% while gold dropped 7.2%. It's not that the fundamental story for silver suddenly changed more than the story for gold. It's that silver's market structure amplifies moves in both directions. On the way up, that's exciting. On the way down, it's terrifying. There's one more element of the silver story that matters here, and it's something I've talked about before, but needs emphasis. Silver is not just a monetary metal. Silver has a significant industrial demand component. Solar panels, electric vehicles, electronics, medical devices, all of these applications require silver, and that dual identity creates a vulnerability that pure monetary metals like gold don't have. When financial conditions tighten, when rate expectations shift hawkish, when the market starts worrying about economic slowdowns, it doesn't just reprick the monetary component of silver, it reprices the industrial component too. Investors start thinking about manufacturing cycles, capital expenditure cuts, inventory drawdowns. They start discounting future industrial demand. And because silver is small and volatile, that repricing happens violently. This is exactly what we saw. Silver didn't just drop because real yields went up. Silver dropped because the market simultaneously repriced both its safe haven role and its cyclical industrial exposure. It got hit from both sides. And when you get hit from both sides in a crowded market with leverage positioning, the result is a 15% down day. Now let me walk you through the technical picture because understanding where we are on the charts helps calibrate what happens next. Gold's RSI, the relative strength index that measures momentum, is sitting around 33.5. That's in weak territory, approaching oversold, but not yet at the extreme levels you typically see at major bottoms. The MACD, which measures trend momentum, has gone bearish at 6.97. Price is trading below both the 20-day and 50-day exponential moving averages, which tells you that the short-term trend is clearly broken. The one bright spot for gold bulls is that price is still near the 200-day moving average around 5,112s. That's a level that often acts as a line in the sand. Long-term investors who believe in the structural bull case tend to step in when prices approach the 200-day. But if that level breaks convincingly, the next support zones are significantly lower. Silver's technical picture is worse. RSI at 29.6, which is officially oversold territory, MACD bearish at negative 2.35, and here's the critical difference. Silver is now trading below its 200-day exponential moving average at around 105.78. That's a more significant technical breakdown than what we're seeing in gold. It tells you that silver has not just corrected within an uptrend. It has broken the uptrend structure entirely and now needs to rebuild. What do oversold readings mean in practice? They mean the selling has been intense enough that a bounce becomes more likely from a pure momentum perspective. But oversold does not mean buy blindly. Markets can stay oversold for extended periods during genuine trend changes. And the fundamental factors I described earlier, the real yields, the dollar, the positioning, none of those have actually reversed yet. So the honest assessment is that the technical conditions support the possibility of a relief rally, but they don't confirm that the correction is over. For that, you need to see stabilization in the macro variables that drove the sell-off in the first place. Now, I want to address the elephant in the room because it's the headline that most people are focused on. President Trump is about to announce his pick for Federal Reserve Chair. And while the mainstream is treating this as the trigger for the sell-off, I think that framing misses the point. Yes, uncertainty about Fed leadership matters. Yes, markets hate uncertainty. Yes, a new Fed chair could change the trajectory of monetary policy in ways that affect every asset class, including precious metals. All of that is true. But the sell-off we just witnessed was not caused by one headline. It was caused by the accumulated weight of tightening conditions, finally overwhelming positioning that had gotten stretched. The Trump announcement is a catalyst, not the cause. It's the match, not the gasoline. And here's the thing about catalysts. Once the move starts, the catalyst becomes secondary to the mechanics. It doesn't matter why the selling started. What matters is that the selling triggered more selling, which triggered margin calls, which triggered systematic deleveraging, which triggered more selling. That's the cascade. And the cascade doesn't care about headlines. What the Fed chair announcement does create is additional uncertainty about the path forward. If Trump picks someone perceived as dovish, markets might start pricing an easier policy sooner, which could provide relief for precious metals. If he picks someone perceived as hawkish, the opposite could happen. If the pick is unexpected or controversial, volatility could expand in either direction. The honest answer is that nobody knows what the pick will be or how markets will react. And anyone who tells you they know for certain is selling you something. What the Fed chair announcement does create is additional uncertainty about the path forward. If Trump picks someone perceived as dovish, markets might start pricing an easier policy sooner, which could provide relief for precious metals. If he picks someone perceived as hawkish, the opposite could happen. If the pick is unexpected or controversial, volatility could expand in either direction. The honest answer is that nobody knows what the pick will be or how markets will react. And anyone who tells you they know for certain is selling you something. The question is whether this is a correction within an ongoing bull market or the beginning of a more significant trend change. And the answer depends on what happens with the fundamental factors. If real yields stabilize or start to decline, that removes one of the primary headwinds. The Fed doesn't need to cut rates for this to happen. Yields can decline if growth expectations weaken, if inflation expectations drop, or if term premium compresses. Any of those would provide relief for metals. If the dollar weakens, that provides another tailwind. A weaker dollar makes gold and silver more affordable for international buyers and historically correlates with precious metal strength. If inflation expectations start to rise relative to nominal yields, compressing real yields from the other direction, that would be particularly bullish because it would signal that the market is starting to worry about inflation again. And if positioning gets cleaned out, if the weak hands get shaken out, and the crowded longs get reduced, that actually sets up better conditions for the next advance. Corrections are healthy for bull markets because they remove the excess speculation that makes markets vulnerable. So here's my practical framework. I'm not trying to call the exact bottom. Nobody can do that consistently. What I'm watching for is stabilization in real yields, stabilization in the dollar, and evidence that the forced selling has run its course. For real yields, I'm watching the 10-year real yield. If it starts declining from the current 1.90% level, that's a signal that conditions are improving for metals. If it keeps rising toward 2% and beyond, the headwind intensifies. For the dollar, I'm watching the dollar index. A break below 95 would be supportive for metals. A push toward 100 would be another headwind. For positioning, I'm watching the weekly commitment of traders' data. A significant reduction in non-commercial net longs would tell me that the speculative excess is being worked off. The current levels are still elevated, which suggests there's potentially more deleveraging to come. For technicals, I'm watching the 200-day moving average on gold. As long as price stays above that level, the long-term bull case remains intact. A decisive break below would change the picture significantly. Now, I want to address something that I know many of you are feeling because the comments and messages I've been getting make it clear that this sell-off has shaken confidence. Here's the reality. If you're invested in precious metals for the long-term structural reasons, those reasons haven't changed. Government debt levels haven't improved. Currency debasement pressures haven't disappeared. Geopolitical uncertainty hasn't resolved. Central bank gold buying hasn't stopped. The green energy transition hasn't reduced industrial silver demand. What's changed is the short-term competition from real yields. And short-term competition is exactly that, short-term. The conditions that created this correction can reverse. And when they reverse, the fundamental case for precious metals will reassert itself. The people who get hurt in markets like this are the ones who buy at the top without a plan, panic at the bottom without a thesis, and repeat the cycle over and over. The people who build wealth are the ones who have a thesis, size positions appropriately, and use corrections as opportunities rather than reasons to abandon their strategy. If your thesis is that precious metals provide protection against currency debasement and financial instability, this correction doesn't invalidate that thesis. It tests your conviction, and conviction that survives testing is the only kind worth having. But here's the caveat, and I need to be the skeptic for a second because you need this voice in your ear. If you were leveraged, if you were concentrated beyond what you could afford to lose, if you bought the top because you got caught up in the momentum and the hype, this correction is an expensive lesson in risk management. The lesson is not that precious metals are bad investments. The lesson is that position sizing matters, leverage matters, entry points matter. And having a plan for what you'll do when things go wrong matters more than having a plan for what you'll do when things go right. Everyone has a plan until they get punched in the face. Well, the market just punched a lot of people in the face. The question is whether you'll learn from it or repeat it. Let me share some perspective that might help frame where we are. Gold's 52-week high was around 5,625. The current price around 4,950 represents about a 12% decline from that peak. In the context of a multi-year bull market, a 12% correction is not extraordinary. It's normal. It's the price of admission for the larger gains that bull markets deliver. Silver's 52W week high was around $122. The current price around $95 represents about a 22% decline. That's more painful. That's pushing into territory where even experienced investors start to question their positioning. But it's also consistent with silver's historical volatility. Silver moves bigger in both directions, always has, always will. The question is whether you're positioned for silver's personality. If you sized your silver exposure appropriately, this drawdown is uncomfortable, but survivable if you sized it based on the assumption that it would only go up. This is the reckoning that overconfidence always eventually produces. Now, I want to leave you with some thoughts on how to approach the next few weeks because that's when the real opportunities and risks will emerge. First, don't try to catch a falling knife. The sell-off may not be over. Oversold conditions can persist. Forced selling can cascade further. Wait for evidence that the selling pressure is exhausted before adding to positions. That evidence might look like a gap down that gets bought aggressively, a test of support that holds on high volume, or simply a few sessions of stabilization after the chaos. Second, watch the macro variables more than the price. If real yields are still rising while gold is trying to bounce, the bounce is likely to fail. If the dollar is strengthening while silver attempts a recovery, the recovery is likely to stall. The macro has to cooperate for any sustainable move higher. Third, use this as an opportunity to assess your positioning honestly. Are you overexposed? Are you leveraged beyond what you can stomach? Are you concentrated in the wrong parts of the precious metals complex? Corrections are the time to fix those problems, not rallies. Fourth, remember why you own what you own. If your thesis is long-term wealth preservation and currency debasement protection, short-term volatility is noise. If your thesis is short-term trading profits, you should have had stop losses in place that limited the damage. Either way, the thesis should guide the response. Here's my question for you, and I genuinely want to see this discussion in the comments. Did this sell-off shake your conviction in precious metals, or did it confirm that you were appropriately sized for volatility? There's no wrong answer, but your answer reveals how you're processing this moment, and that processing will shape your future decisions. Drop your thoughts below. And if you've navigated previous corrections successfully, share what worked for you. That kind of real-world experience helps the entire community learn from moments like this. Before I wrap up, let me remind you that the links to the WhatsApp community and X are in the description. If you want the fast updates on how this situation develops, the real-time analysis when important data comes out, and the perspective that doesn't wait for full video production, that's where you'll find it. One more thought on the psychology of moments like this. When markets sell off hard, there's a natural human tendency to construct narratives that justify the move retroactively. People will tell you that the sell-off was obvious in hindsight, that the warning signs were clear, that anyone paying attention should have seen it coming. That's nonsense. Markets are not predictable at the level of individual moves. What's predictable is the pattern. Bull markets have corrections. Extended rallies eventually mean revert. Crowded positioning eventually gets unwound. Those patterns are predictable. The timing is not. So don't beat yourself up for not selling at the top. That's not a realistic standard. Instead, focus on whether your process is sound. Did you size appropriately? Did you have a plan? Did you know why you owned what you owned? If the answer to those questions is yes, the outcome of any individual trade matters less than the long-term trajectory of your portfolio. And if the answer to those questions is no, this correction is the universe's way of telling you to fix your process before the next cycle begins. All right, let me bring this together with a final thought on what the current environment means for precious metals investors. We are in what I would call a tightening without panic phase. Financial conditions have become restrictive enough to penalize assets that don't produce income. Real yields are high enough to compete with bullion. The dollar is firm enough to create headwinds for international demand. But we're not in a crisis. We're not in a panic. We're not in the kind of environment where everyone abandons risk assets and runs to safety. That's a challenging environment for precious metals because their primary value proposition is protection against things going wrong. And right now, things are not going wrong enough to trigger the flight to safety flows that would offset the carry disadvantage. This can change. It can change quickly. A geopolitical shock, a financial accident, a sudden shift in growth expectations. Any of these could flip the environment from tightening without panic to crisis mode. And in crisis mode, precious metals tend to perform very differently. But until that happens, we're likely to see continued volatility, continued sensitivity to rate expectations and dollar movements, and continued corrections whenever positioning gets too extended. That's not a reason to abandon the asset class. It's a reason to manage it appropriately. It's a reason to use corrections as opportunities. And it's a reason to maintain the long-term perspective that has served precious metals investors well across decades of cycles. The people who build generational wealth in markets like this are not the ones who time every move perfectly. They're the ones who stay in the game, manage their risk, and accumulate during periods of fear and pessimism. This correction is creating fear and pessimism. How you respond to that will determine your results more than any analysis I can provide. All right, that's everything for today. I'm going to leave you with a line that applies to this moment and to markets in general. The same volatility that creates the losses you're worried about today creates the opportunities you'll be grateful for tomorrow. The only question is whether you're positioned to survive the first and capitalize on the second. Stay sharp, stay patient, and don't let the sell-off steal your conviction in a thesis that remains fundamentally intact. I'll see you in the next one.